right, welcome to the closing beat, everybody. Happy Thursday. How you doing out there? Hope you're doing better than us. We're still working through the audio stuff and this whole new setup and everything. I do appreciate you guys hanging out with us and sort of putting up with the mess here. So I will do you a favor for putting up with us. And today I'll make it a teaching day. You guys may know already that we have a research site that we're putting up for people that can't be customers, but you just want access to the research and sort of that data. Actually, if you go to our website, jazzwealth.com/research, you can kind of see a description of what we're doing. You're seeing some of the familiar slides and things that we're going to be offering. Very, very cheap. We're just putting it up there because we want to hire a developer. And so if we offer you more and teach you more, we're hoping you'll check it out. You can go to the bottom, put your website in there, and your email address, and we'll email you one time. We'll email you when it's ready to go. And so I hope you'll check that out. But what I want to use today to do is to kind of teach you some stuff because the markets were sort of flat today. You can see on the screen there, the Dow was down a touch, S&P up a touch, Nasdaq up a touch, Russell kind of up a touch. So we're going to use this as kind of an education today, and I'm actually going to take and show a couple comments from some of the videos I've been watching and use that to teach you something here as well. We're going to talk about international stocks, steel stocks. We're going to break down the S&P as far as sectors go and show you a couple things there, so I hope you'll stick around and check it out. Here we go. You got the Nasdaq, basically the leader on the day. It was pretty even across the board, as you can see, not a whole lot going on there. Tech and consumer staples were the ones that led you higher, Microsoft, T-Mobile, PayPal, things like that. The Dow was, of course, your laggard on the day, not too bad there. Home Depot, United Healthcare, and Goldman Sachs dragged Boeing a little bit as well. We'll cover some of those stocks. Here's what you had overnight. The news is going to focus on the Bank of England. They decided to increase their bond purchases by $100 billion, but in fact, there were 5 total central bank adjustments throughout the evening, although Bank of England gets the attention there. Brazil and Indonesia cut rates. Switzerland and Norway, which we'll talk about later, left it no change, and Norway actually said they're going to leave rates zero for the next couple of years. Their quotes, not mine there, so kind of interesting there. You wake up, we get started here in the U.S. with all that to digest, and you've got the jobless claims. Jobless claims, let's check it out here. On the chart, you've got the U.S. jobless claims there. They were up $1.5 million, $1.5 million, as you can see, versus 1.35 expected. Here's the thing. They still declined. You can see we're declining here year to date. It's not great. It's a nasty, nasty spike. But year to date, we're still declining overall at a slower pace. This is now the 11th week in a row that the jobless claims, initial claims, have declined. I'll give you a hint. The market doesn't like 11. Let's play a fun game here and see what initial claims are next week, because that's like a nasty word to the market. Anytime something happens 11 times in a row, it doesn't matter what you're studying, you tend to find negative results going forward. I don't know why it is. I don't have anything interesting to offer there other than to say that's like voodoo number for the market. So you got 11 times in a row. Let's see, just for fun. We'll come back to this next week and see what happens. Somebody may remind me there. We'll be back live by then. Here's the problem that I have and that I've been sharing with you guys: continuing claims. We'll back out initial claims and look at continuing claims. This is what's driving the forward thoughts and forward decisions in the market. Continuing claims are flat. That's not good. That means more people stayed on, not more people, the same number of people stayed on jobless claims versus coming back off of them and going to work and getting back to life. This is not good here. When this started to decline, if you compare that to the markets, you can see a nice little healthy pop in the markets. It was exciting to see people go back to work. Ooh, that's a nasty number there. I'm just saying. We didn't see much in terms of response today. I have a feeling that's going to play into the performance going forward, and we'll come back to it. Don't you worry. We'll get there. So this week, our FinTips videos, we had how to improve your dividend investing on Monday. You want to check that out. Avoiding international funds yesterday, or just the thought of that. I'm going to expand on that today thanks to some of the comments and share that with you. Tomorrow, we've got a new 401k rollover strategy you might consider if you're unemployed. Tonight, we got a great class for our customers because we took it a step further than we thought we were going to do. We are going to cover pullbacks in the beginning stages of a bull market. This is currently a bull market, like it or not. And we're going to cover how many times we had pullbacks and what pullbacks did we have to compare this bull market that we're in to all the other ones and see what happened there. So holy cow, it's going to be a really good one. We'll see it tonight, 8 o'clock in the dojo if you're interested in that one there. Now, before we move on, let me actually start with the first lesson here. Our Wednesday video, should you avoid international funds? We went and talked through the averages and everything. And Mr. Andrew Harris left us a comment along with a couple others that said, hey, it's probably worth noting that the U.S. markets are also very expensive now versus international. And I don't think there was any, it wasn't trying to be rude or anything. So I'm not picking on Andrew here. But I want to be careful when people start thinking like that, because we want to ask the question, is it true, right? How do we justify that? And is Andrew anywhere near right? Or maybe there's some room to further educate. So I want to use this today to teach you. Hang on, it's going to get a little geeky. Just stay with me here, right? A lot of people are looking for opportunity because they feel like the U.S. markets are expensive, but are they? What we're going to do is we're going to look at the valuations of the U.S. market compared to every other one of them out there, and then we're going to actually plot them on not a graph, but a spreadsheet to show you how expensive they are relative to different time periods. So let's just dive in, take a look. Okay, hold on. Here's all the countries here. Norway, as we mentioned a minute ago, they actually rank as the most expensive. Now, it would have been easy for me to just respond to Andrew and say, no, you're wrong, or cherry pick some expensive area and say, Japan's more expensive than us. That's not fair, right? So I want to do a little research for you. Norway, expensive. Brazil, Spain, Japan, South Korea, Germany, Italy, and UK are all currently valued more or more expensive on a valuation basis there, PE using for this one, than the United States. Doesn't mean the United States is expensive, compared to some versus others. You can see that there. What's really a step further here is, how does the current valuation of any international market or wherever you're looking compare to itself over the 1, 3, 5, and 10-year period? So for example, let's go to Norway. Looks very expensive compared to everybody else, but is it expensive compared to itself? So over the last year, it is in the 96th percentile of how expensive it's been. You could say, yes, it's stretched in the short term. Over the last 3 years, yep, it's stretched. In the last 5 years, yep, it's stretched. Last 10 years, it's stretched, right? What's interesting is if you look to the bottom, you may be attracted to these areas and say China, South Africa, Hong Kong, Singapore, Russia. Wow, maybe I'll look for investments there because I'm paying less to participate. I can't speak for returns, but I'm paying less to participate. What you want to look at is something like a Singapore. It is, yes, it's trading cheaper compared to everybody else, almost everybody else. But in the last 1 year, it's also at the bottom end of its range, right? So for whatever reason, last 3 years, it's still trading in basically the 10th percentile, meaning if there were a range from 0 to 100, how expensive could it be? We're down here at 10, essentially. 5 years, 5, 10 years, 17. So you would say, okay, that's a discount compared to everything else, also a discount compared to itself. So that's where I wanted to take Andrew through maybe a step further and show, is it a discount compared to other markets? Yes, we could make the argument and agree with Andrew, but we could also disagree with Andrew as well and show other examples. I put the median in there as well, so you can see the United States is technically just slightly more expensive, and it is stretched in the short term. Not so bad in the 3-year time period, but if you're making an argument that the U.S. market is more greatly valued than where it has been, yeah, I totally buy Andrew's comment there. We could make that argument. There are other countries you could certainly do worse. What's the lesson though, Dustin? Thank you for sharing the data, and that's great that you know how to put all this together and color code each box and everything. What's the lesson here? The lesson is to know what's inside your international funds. If you're participating in that category, you either had a really good time or it hasn't gone so well. For example, if you find that your international fund, they're not all the same by the way, is highly correlated to Spain, you realize that you're paying more and hopefully the returns justify that. If you see that you have a high allocation to Japan inside that fund, for example, like this guy here. Here is an ETF that has a 69.1% exposure, and it's not the EWJ, but has a 69% exposure to Japan. Well, if the returns justify paying such a high price, and now you know that it's valued more than it has been and is stretched over the short, mid, and long term, then you keep it, right? If you look at this and you say, holy cow, I'm invested in something that's really, really expensive, you gotta do that research, right? If you're one of our customers, I'll do it for you. But you gotta look through that and say, Japan, 70% of my money is going into Japan. It is one of the most expensive areas, and compared to itself, also kind of stretched. Do I want to participate in that? Are the returns justifying the valuation that I'm spending for that there? Was that too much? That was something different. We don't normally cover that, do we? That was a little bit different there for you. So I wanted to share that with you. I'll move on because I got more stuff to share with you. We're going to go to the sector breakdown here and take a look at some of the different sectors, and then we'll get into more stuff here as we go. So go back over to the charts and let's take a look here. We're going to do a deep dive into the S&P sectors in just a second in terms of how they're performing and the weightings and everything. But first, we'll start with energy. It was the worst performer over the last couple of days. Today, it was the best performer. So just trying to recover a little bit there. Technically, it's moved back into chop zone area here, like a lot of stocks in that category have. And, kind of give it a break. It's had a great move there. I looked through there just a little bit for you to see if I could see anything that stuck out. Phillips 66 stands out right smack off the 50-day moving average. Great recovery today, a 5% gain. I believe it was the best performer or the best contributor to the XLE today. And you find that interesting. It doesn't matter. They got an upgrade from Raymond James. $85 is their price target with an outperform rating, which you guys know that just means they think it's going to beat the sector overall. But what I like about this is the fundamental traders get something, technical traders get something, and today you get proof that other people are participating. Doesn't get me in trouble for saying, hey, that looks pretty good. Occidental Petroleum also had a good day, 3 1/3% higher. So not bad there in the energy sector. A little bit of recovery off some of that support area that it's been going into. Real estate down 1 1/4% on the day. Utilities was weak on the day as well. Not as bad, but throughout the day, they kind of stuck together. If we go over back to real estate for just a little bit here, the big leaders, your American Tower, they just pulled back. They've been really strong. We've talked about the data center REITs. You got Prologis in there, very strong, just pulling back here in the short term. Equinix, very strong, pulling back here in the short term. Nothing wrong with these. It's just they had an off day, and that pulled back the real estate in general. Realty Income, very popular one with all you guys out there. Ticker symbol O was up 0.5%. That one gets a little bit of relative strength, I think, points for today. Healthcare continues to be at this 50% area. We talked about this yesterday. It's going to be a bit of resistance. It's very normal, and it's usually very short term. You very often do not see a sector or a stock fall so aggressively, bounce halfway, and then never do anything again. They tend to accept or reject the 50% area quite rapidly because there's a lot of different strategies that revolve around that area, and you tend to have people making up their minds rather quickly. It's a place where people like to get in, they like to get out, so you get a little bit of sort of solution quickly. Johnson & Johnson, I think, gets a little bit of a relative strength award today as well in the healthcare space, although it was down a little bit. Not too bad there, trying to bounce off the 200-day moving average. We'll see what happens going forward. Tech, sort of a blah day. I don't know, right? It's had a 10% run over the last month, so we'll give it a little bit of a break. You've got Apple just a touch higher today. It sort of floated around. Microsoft continuing its monster little move. Both those stocks make up 40%. They just kind of were blah today. I don't have a TV word for you to use there. Salesforce.com sticks out because that's just a recent little breakout here. Not the cleanest, so I won't claim that that's something I would have looked at. But you got 3.5% higher today for Salesforce.com. Government contract news coming out of them. Broke the range, got about just a touch over average volume there in the short term. So that one kind of sticks out. PayPal also hitting new highs, just a monster, right? Up over 50% year to date. Susquehanna now says 190 as a price target from 150. Citigroup says 186. Their comments, not mine. It's getting a little extended in the short term. And let's move on to a lesson. All right, here we go, right? Kind of a blah day for some of these things here. So I'm going to dive back. Wanted to go into, I always have this stuff ready for you, just in case. Here is the S&P weighting by sector. You know that the S&P is a market cap weighted index, and so basically the bigger you are, the more you get to play. When you break it down by sector, you can look at the market caps of each individual sector. In other words, the current value of the sector. Take up all those shares of every single stock and times them by the price, and that gives you the valuation there. Anyways, here's what we've got. You can see all the different sectors broke down. First thing you might notice, technology. Well, I'm no math genius, but 26.7% seems like just about half, double of the healthcare sector, meaning technology is currently and has been the dominant force in the S&P. If technology goes lower, it is highly likely that everybody else is coming down with it and the S&P is going to head lower. That's why we say things like that. Now, we used to say tech and financials were where you wanted to focus, and that's because financials used to make up the second biggest space. Thanks to the healthcare rally lately, now we've got healthcare in second place, so you've got tech and healthcare. So the saying would go, now as tech and healthcare go, so goes the market. Well, the reason for that is you've got going on 40% of the market made up of two different sectors. So it shows the importance of that there. Just want to point that one out. There are other good sectors as well. Financials, consumer discretionary, communication services. They got double-digit gains, right? Double-digit weightings in the overall sector. So we don't want to argue with those. They are obviously did well also. Here's the thing. Occasionally, we'll check to see the change in the weightings. Just over time, did one place add more? Did one place lost some of their weighting? And we're going to do the same this time. Here is the year-to-date change in the weighting. So in other words, starting from January until now, what's happened? Who's taken over more? Who's lost a little bit? Well, tech has gained another 3.5%. Dominant move there. You can't ignore technology. Unfortunately, on the flip side, you got financials. Financials have lost 2.3%. What does that tell you? You've got the financials not participating as much right now because of the low interest rates and predicted low interest rates. We all know interest rates are low, but expected interest rates going forward, not a good sign for banks there. So they haven't underperformed. They haven't dragged. They just haven't gained any weight in the overall S&P. I would argue that maybe because tech and everything has moved on, it sort of stole some of that from them. Energy, we can understand why that's happened. And industrials, if you're big on the infrastructure bill or for whatever reason feel like that's going to be something there, it kind of gives you a hint that maybe there's some opportunity there if you want to go do some individual stock research. And so occasionally it's nice to see what's moving the markets, what's holding the biggest, and clearly it is technology. Look at materials, 2.5%. It's almost like it doesn't participate. Real estate, energy, utilities, that's just crazy. You take tech and then add up all the other 6 bottom ones there, and that's essentially the weighting it has. In other words, tech could be higher on the day, and those 6 bottom sectors could be lower. And if the rest of them were flat, the market would be perfectly flat, right? We'll have to watch out for that, see if we can share that with you. All right, that's all we got there. Let's go over to the technical breakdown here, take a look at a few things. I just wanted to make this kind of an educational day, but pertain to the market if we could. You've got 5 new highs today. They're all familiar names. We're not going to tell you anything you haven't heard already. Tractor Supply, we pointed out yesterday. You got your gaming stock, Electronic Arts, 1%, not bad. You got Adobe in the mix, Clorox, PayPal, we already mentioned. You've seen some of the strength there. Careful. Some of these had more narrow range days, so it's just something to consider if you're looking at, well, how exciting was it? Did we just touch the new 52-week highs? Like PayPal touched it and then gave you something, right? Where some of these is just like, oh, we just touched the little high there and then floated around. Anyways, you got 4 or 5 of these stocks up double digits over the month. So careful, maybe losing a little bit of steam there over the next couple days if they continue this mess. Pointed out ConAgra, the possibility of a little bit of a breakout here over these highs. It's still building. It's a watch list stock at the moment, I think. Holx, we talked about this one yesterday. Hologic's the name of the company. HOLX is a ticker symbol. Still hinting. Today was a great relative strength day. The markets were sort of blah, can't really get anything going. This stock said, nope, we're going to make something of today and try to build up some momentum towards those highs. Volume was a little bit higher as well just today. So that lets you know that other people are saying, I can't wait. I want to play the breakout, but I can't wait for it to happen. I'm going to sneak in a little bit early. That's kind of the mentality you got there. And that's it for the technical breakdown. So we'll move over to stocks in the news here because there are a couple of them, and then we'll get out of your way. Hertz, they have officially said, and the stock is still halted, by the way, they have officially said they are not going to sell the shares. Remember yesterday we told you what the SEC said, and so today they decided they're going to listen to the SEC and say, we're not going to sell. Instead, they're going to look for $1 billion in bankruptcy financing. This is why, and by the way, I say this a lot, some of you disagree with it, but this is why you borrow money when you can, not when you have to. Can you imagine applying for a loan in bankruptcy, how much that's going to cost them versus if they could have just sold some junky shares to you or borrowed the money a long time ago? Borrow the money when you can. This company is a great example of now they need to borrow money and they almost can't borrow the money. Anybody that loans them money is going to want a pretty penny for that money. So borrow money when you can. Kroger, we talked about the earnings there. Yesterday, we said only 33% of the time when it gaps on earnings does it close higher than where it gapped to. Well, today it actually gapped down just a little bit on earnings, which is kind of interesting because I would have thought that was a deal, right? The fact that it gapped down, great earnings, everything's good. They didn't guide so much going forward, in particular how people were looking for that, but still, I thought that would have been a deal today. Somebody did because apparently got a little buying there through the end of the day. But again, Kroger fits its historical statistic where it gapped and did not finish above where it gapped. It gapped and faded. If you want more information on that, yesterday's closing beat was a great way to kind of look at the stats on that. Something about Kim Kardashian and Spotify means a 13% rally in the stock. CMC, commercial metals. You ever look at steel stocks? Most people don't look at steel stocks during what's recessions. We're technically in a recession. Most people don't look at that because steel stocks are not the stocks to buy going into a recession. General rule, write it on your mirror in your bathroom or something. That's what you got. Here's the thing though, this is the best performing steel stock out there. Not just today, I noticed it today, 5.5% gain on the day. I said, well, let's do a little research on this thing. Over the last year, right, only one other steel company has positive gains, and it's like 9% or something. These guys got double-digit gains on there. They've been sneaking a little rally by on you, but this is by far the strongest performing steel stock out of the group. There's like 23 names to look through if you want to look through that. Just thought it was interesting. It started the day higher. It even gapped higher on the day. Caught my attention this morning. I thought we'd do a little research there. I don't know where that puts you, what you want to look. Carnival down a little bit on the day today. Missed on earnings, weaker revenues expected. I don't know if that was news. Fitbit, obviously being bought by Alphabet there, and in Australia, they're not excited about it. They said, we have some concerns there. Other than that, you've got Broadcom paying out $3.25 in dividends there, ticker symbol AVGO since the merger a couple years back. I pressed a button and nothing happened. Did you see that? That's why we switched the software. We've been having all these troubles with all this stuff we're doing so that I can't accidentally press one button that I occasionally press. Just kidding. Philip Morris, $1.17. Dick's Sporting Goods, 31 cents. World Wrestling, 30 cents. Surprised did they really pay that out? Come on. No. Somebody put the ticker on there. This is Washington Real Estate. Somebody put, no, yep, all right, confirmed. That is not World Wrestling. They should not be paying the dividend. That's why that makes sense. Washington Real Estate's paying out the 30 cents. Little thing must have got off there. And Johnson Controls, down a little bit on the day. They're paying out 26 cents. On the 22nd of June, we will cover the changes again in the S&P and the Nasdaq. You've got some big changes there. Nasdaq 100 and the S&P 500, lots of shifting around there. If you're an index fund person and you like to build your own index funds or whatever you got going on there, something you probably want to know about. So we'll cover that. And yeah, other than that, that's pretty much all I have for you for the day. Thanks so much for watching. I think this should be a lot better today. We hope to be live again starting next week. We're testing every day, finding all the bugs, getting everything set. There's really a lot going on, with trying to set this up. And also, if you're interested in the research site, like I said, we're not trying to make millions of bucks. We're trying to hire a developer to put here in a chair and make more cool stuff for you guys. And so we thought we'd just offer you a little bit of something. If that helps you learn and everything, maybe you'll support us. If you do, I greatly appreciate it. All you have to do is leave your email if you want me to let you know when it goes live, or you can just wait till I make a big deal out of it. Either way is up to you. But no, we won't do the spam thing and all that great stuff. And that's it. Hey, have a great rest of your day. We'll see customers later, 8 o'clock tonight. We'll see you in the speakeasy for our class. Hang on. It's going to be short, but some good stuff in there. And adios. Yeah, that'll be